Holy, is it ugly out there right now. We have the Nasdaq down nearly 5%. The S&P looks to be down nearly 4%. And I can't remember this type of volatility. I'm sure there was a few days like this during the rapid inflationary period during 2022. But for the most part, this type of volatility, the only thing I can think of, the market crash in 2020. And if we think of the overall uncertainty moving forward, I mean, we're talking similar levels of uncertainty, which seems absolutely absurd to say because that was a global pandemic that effectively locked down the economy. But the tariffs that have been put in place yesterday have I'm going to go right out on a limb and say that if these actually stuck in place for a long time, there is pretty much a guarantee we would hit a recession. We're probably already going to hit one here in Canada, but if those tariffs stay in place for a long duration of time, it's almost a guarantee we're going to hit one in the United States. So I'm going to go over my overall thoughts on the markets right now, what I've been doing over the last while with my portfolio, and just give my thoughts on this current situation overall. And as always, everybody, down in the description, I got that report for 3 of my favorite stocks for 2025. It's absolutely free. It takes you a few seconds, and you could find some opportunities in this massive sell-off. So as we can see here, I'll refresh it here. We're down, I believe, the Nasdaq almost 5%, the S&P 3.91, the Dow Jones 3.57, and if we look here to the TSX, 2.81%. So the TSX has not even been saved from all of this, even though tariffs were not actually applied, reciprocal tariffs were not actually applied to Canada or Mexico. We're saved from that for right now. Now, the first thing I'll go over is just my basic thoughts on tariffs. I don't really understand them whatsoever. If I were to give my thoughts as to what is going on, I would imagine this seems so absurd that it seems it would be an intention to tank the economy intentionally in order to get interest rates lower, to effectively improve the debt situation in the United States, things like that. That's my conspiracy level thinking there, but I think it might actually be somewhat accurate. I see no other reason to do this. It seems like they are hell-bent on bringing back a lot of manufacturing style jobs, factories, things like that. But the difficulty here is the United States has not been a manufacturing economy for quite some time. When we look at the tariffs on places like Bangladesh, places like, Thailand, things like that, like they make a lot of clothing. They make a lot of clothing cheaper. People in America do not want to work those jobs. So that is why they are outsourced overseas. And with these large-scale tariffs, the effort here is probably to try and bring some of that manufacturing home. If you think about the overall cost to the consumer, to the American consumer, it would be wild. It would be wild to actually have to do this, to actually have to manufacture that stuff in the United States where labor costs are higher, exponentially higher. So those costs go up. So the alternative would be companies still source their materials from those countries, and all they do is apply the tariff back to the consumer. So there's a real fear here, and I would be fearful of inflation going up quite a bit in the United States because, I'm just talking about one single industry here, those reciprocal tariffs on, a lot of clothing manufacturers, things like that. But this is like he's put them on a ton of countries for a ton of goods. And even if you apply the logic and you actually believe them that there's going to be short-term pain for long-term gain, the short-term pain could be significant. You're looking at, again, a 5% loss in the Nasdaq. So I don't really understand the tariffs. I never really will. I'm sure if you think they're taking some sort of different angle, drop it down in the comments below. I would love to hear it. But for me, this just looks like an outright purposeful intention to tank the economy, because why else? Why else would you be doing this? And obviously the market feels the exact same way. When's the last time the Nasdaq dipped 5% in a day? So what have I been doing with my portfolio? Well, I've primarily been accumulating companies that I don't feel will be impacted by tariffs or I feel will actually benefit from tariffs. I can look to a company that I added recently in CargoJet, a Canadian domestic freight company that I do believe would actually benefit more from tariffs rather than be impacted by them, especially when we look at the Buy Canada movement, things like that. Obviously, that will increase demand for domestic shipping. Obviously, in the event of a recession, cargo jet would still take a bit of a hit because of the lower freight demand, but I do believe overall, if tariffs stick around, that is one company that is set to benefit. But I've made very little moves since late last year. First off, I felt the market valuations were exceptionally high, so I kind of started accumulating cash over that time period, and then as the markets continued to dip, I just kept accumulating more and more cash. Now, I would want to highlight, this is the first time, and I've been doing this for 16 plus years. This is the first time I have never not remained 100% invested. Typically, I get weekly contributions in, I buy stocks, I dollar cost average into all my holdings. I don't particularly try to time dips. I don't, valuations to a certain degree don't really bother me because if you dollar cost average, you're buying, some at the highs, some at the lows. You're ultimately getting the best of both worlds. But this situation, I think right now, is a time where I felt that I just wasn't comfortable investing in a lot of equities. Yes, I've been buying some, but for the most part, the vast majority of my money has just been going to whether it be U-bill, my US dollars, or cash, just money market funds, things like that. We have to think of this situation. I mean, there's never been another situation like this. We can look to pretty much effectively pre-World War II, when they implemented tariffs in the 30s to kind of help with the Great Depression. And not only did it not help, it actually amplified it. It made it much worse. And the thing is the average tariff that he put in place yesterday is larger than the tariffs we witnessed in the Great Depression. On average, there is a higher tariff in place today than there was in the early 1930s. So I know there is some notions that it's simply dollar cost average, buy and hold. Don't, be scared by the news. Don't be scared by the headlines. But I really do think this is a different situation. I mean, we actually have massive regulatory changes from one of the most stable nations on the planet that are, some economists feel it is absolute economic suicide to be doing this, and they're doing this. So in that case, I have started gathering a bit more cash. I'm going to make strategic buys here and there, but I'm in no rush to deploy the cash that I do have, because my portfolio this year is down like 3 or 4%. It's really not down all that much. I am fully prepared for that to go, south of 20%. I feel that is a realistic possibility considering the environment right now. Again, I'm still, 85, 87% equities. It's not like I'm trying to time the market and sell out of all my stocks and hoard cash, but I do have a cash position that I'm going to continue to accumulate to that should give me some opportunities should the market continue to dip. So in terms of what I'm doing, I'm just being fairly cautious. I believe that is perfectly reasonable. It's perfectly reasonable right now to not just head out on the first day of a 5% dip and dump your money into equities. I know there's a situation, there's a lot of the Buffett quotes tend to pop up a lot right now. Buy when there's blood in the streets, things like that. But there's a lot of uncertainty right now. And if you are worried about buying equities right now, that is a perfectly reasonable thought process. Would I go out and panic sell all my equities? No, but I also do that with the idea that I'm a long-term investor, and the fact that, I do believe that the markets could potentially dip another 15, 20%. Most people would believe that, if you think that, why aren't you selling all your stocks? Well, I just buy and hold them. My time horizon is 15, 20 years. So I just hold that, but that doesn't necessarily mean that I'm going to be pulling the trigger either on new purchases. And you know what? I can earn, 4+% on those US dollars, and I can earn, it's probably around 2.75 right now, 2.5 on the Canadian dollars, which, it has been a lot more than the market returns this year. I can tell you that much. There's a big swing there. But anyway, that's what I'm doing. I do believe right now is going to be the absolute most important time, probably, especially if you're a beginner or you've been doing this for 5 years or whatever. Know what you own and why you own it, because this is probably going to be one of the most volatile times in the market we've witnessed, probably since the financial crisis. Donald Trump could easily just take the tariffs away tomorrow, which is why it makes this such a tricky situation to navigate. He could increase the tariffs tomorrow. Absolutely anything can happen. He's shown to be able to flip back and forth numerous times, which makes it effectively impossible to time this situation to predict what is going to happen, but I hold that cash. I'm in no rush to deploy it, and I still remain very heavily invested in high quality equities. And when I feel the volatility has settled a bit, I'll start to deploy some capital back into stocks. Now, a lot of people might ask why my portfolio is actually doing fairly well this year. It's really not down that much, and I would argue that that is likely the Canadian exposure end to my portfolio. So back in 2023, 2024, I had a ton of investors come to me. They sold their Canadian equities and they bought into the S&P 500 for the reasoning that the S&P 500 always returns more than Canadian stocks and international equities, things like that. I mean, they got caught up in a lot of recency bias. I mean, it's a huge downside when it comes to retail investors. They look at the past returns of a particular index or a particular stock or a particular ETF. They buy that assuming the forward returns will be equal, and they often sell out of assets that are underperforming but at substantially lower valuations, and they buy into these higher valuation indexes because they've returned a lot in the past. We're sitting on 1-year returns. The TSX is the best performing index by a mile. Like, it's up 12% over the last year, while the S&P is up around 4, the NASDAQ is up around 3. So has the tide turned in that regard? Is the TSX going to be the better performing index moving forward over these US indexes? It's difficult to say. I would say if Donald Trump's tariffs persist and the US economy faces some pretty substantial pressure, there could be a good opportunity for that, because the one thing about it is Canadian equities trade at large discounts to US equities. So a recession in the United States would probably bring these valuations down on the S&P 500, on the NASDAQ 100, things like that, a lot more than they would the Canadian end of the market. Do I believe the S&P 500 will be the index that outperforms the TSX over the long run? Absolutely. However, I do feel a lot of Canadian investors last year got fed up with their Canadian equities. They sold them. They kind of got caught up in the run that the NASDAQ and the S&P 500 have been going on over the last few years. They heavily allocated to those indexes. And, who's to say what happens over the next year or two, but it might have been poor timing. This brings me to the final point I will talk about in this video, is the diversification element of it. I've had a lot of people come to me over the last few days or so, few weeks, and be like, what do I do? I need to prepare my portfolio for this. What do I need to do? What should I be moving around? And I'll tell you right now, when it comes to a situation like this, once you are actually caught up in the situation itself, you're too late. You need to be proactive to situations like this, not reactive. You can't be over allocating your portfolio to, let's just say, for example, growth heavy, high valuation stocks. And then when, the NASDAQ is down, well, what are we down year to date? We're probably down, 15%, 14%. When the NASDAQ is down 14%, now you want to move things around in your portfolio. You need to be proactive with something like this. You need to maintain a diversified portfolio at all times. You can't just chase constant returns, and then when that kind of bites you, you want to diversify now. It's often too late. I maintain a diversified portfolio almost at all times. I don't heavily allocate to specific sectors that are doing well. I keep a diversified portfolio at all times, so that when a situation comes like this where, the S&P 500 is down 8%, the NASDAQ 14%, I'm down like 3 or 4. And it's not even like I gave up much upside over the last few years either. I mean, I think it was just over 30% returns in 2024. And now that the markets kick into 2025, I'm seeing a lot lower drawdowns. If you're looking to make moves right now and you weren't just, building a diversified portfolio over the years, that's just something, if the markets continue to draw down, you might learn a hard lesson about that. And maybe moving forward, you'll diversify your portfolio and keep it diversified. Way too much heavy concentration. I mean, I can see it in a lot of investors. They're heavily concentrated in the Magnificent Seven, in the NASDAQ, in the S&P 500. They don't have much international exposure, if any at all. They have very little exposure to Canadian equities. And it's kind of getting them in a bit of trouble right now. But again, we look to that point, the time to actually prevent that is before situations like this actually happen. no matter how safe the United States is from a regulatory standpoint, from an economical standpoint, I mean, we have a guy in power right now who is putting in some very, very harsh regulations, tariffs, things like that. And this always should bring you home to the concentration of your portfolio in a single country. It's something you always need to consider. And it's something you need to consider not while the equities in that particular country are down 14 or anywhere from 8 to 14% a year. You need to be thinking about that before situations like this happen and maintaining a diverse portfolio at all times. Anyways, everybody, I probably rambled on long enough. That's my overall thoughts about the situation right now. Head down below, subscribe to the channel, like the video, grab that free report highlighting 3 of my favorite Canadian stocks for 2025. There's also a link to the Stock Trades Premium platform down in the description below if you want to join up on that. And as always, everybody, we'll see you next time for more great Canadian content.